All right, good evening, guys. This is the nightly strategy podcast for Tortoise Capital for March 23rd, 2020. And the Fed comes riding to the rescue with trumpets blaring. We'll see how that works. So we finished yesterday after the recording stopped. And I just wanted to just highlight some things. So this was a sketch that we made about 5 years ago about daily day trading, calling it the chain trading, and what was 5 years ago an emerging standard practice where we studied the opening, the gap, and then we used frog champions and what we call the hybrid frog to get started right from the open. And then in the case of it selling off, that we would either get it would pause and give us a P1, and then that would either give us a reversion to the mean with an owl trade, or it would be a continuation for the second leg down, and that this would all happen within the first 15 or 30 minutes, and that 30 minutes in, we would be able to use that hybrid frog in chain trading to get some initial trades, and then we would be framing the size of the day as a function of the range stat. We would use the 30-minute and 2-hour charts to start figuring out support and resistance from yesterday and from the last 10 days, and then start using combinations of the frog box or the hybrid frog or the RLCO framework to start looking at sideways quiet channels or continuation patterns. And then that morning trade would then give us the geometry or the trade structure that would allow us to continue through the lunchtime and into the afternoon and then be flat by the end of the day. So that's where we were in terms of sketching out the ideas, and we refined that a little more in the as we looked in greater detail about the hybrid frog and the owl and the collapsing dragon or the P1 failure and how that could become a sideways quiet channel. And we just called this basically chain trading, where we start with a hybrid frog, and then if we get an unambiguous move, in this case like an unambiguous down move, then that thing resolves either into an owl that wins to the upside, a P1 failure that continues to the downside, or continues forward chopping along into a sideways quiet channel, which could end up becoming the Z3P. So later on, that became expanded into our understanding of the pinch and super pinch, in which the 4 regression lines that we track, each of which represents some kind of price action by some demographic of trader. And when all 4 of those things collapsed inside a very tight range, like a frog box, or inside the intraday Z3 lines, then we would have a super pinch, which could then, when the breakout happens, become that hybrid frog and into chain trading. And from here, it's either going to revert to the mean, which was the original 270, or on the way up, it would hit the intermediate target, which was the RL90. And then we could start using the expansion from this super pinch to start calibrating the sizes of the moves. And when we applied this in our regular life, we saw, this is Brazil from the year 2016. So we've been doing this, for 4 years. Here was a hybrid frog move down, first one. Second one came down into a P1, and then an owl trade, and then we cashed it, and then that ended up becoming, it's either going to be a continuation or it was going to be a fail. In this case, it failed, so we covered. And then we get another owl, and then a re-entry. When that P1 failure didn't happen, you get the second leg up, and thus you go. So here we are 3 and 4 years ago, just routinely following what started off as sketches and an appreciation of our technique, and that's why we assess. When we do plan, prepare, execute, assess, it's from that tested experience and assessed experience that we find the things that are working and then refine that from a feeling into an intuition, into a description, into a directive, into a strategy, into a system that can then be standardized and implemented. Here was another one where it was just a hybrid frog, and this is Alcoa. This is back when it was trading at 10 and an intraday move for an R. And then this was one of our traders just talking about how he did his thing. Then here was another one on EWZ where we did a hybrid frog in cash, a mini scratch here on the short. The continuation worked, and then another short owl. And so just calibrating our moves and getting paid all along the way. And so it really does make sense to plan and to plan ahead. Duh. So let's just keep thinking. All right. So today, here's what we got. So the started off with a limit down futures. So there was a big gap down. So I started trying to get short and mucked the trade. It gave me a low, a higher low. So I tried to get long and mucked the trade. So then I tried to get short on a collapsing dragon. Didn't work. Had to take another fractional loss, mucked the trade. This one, then right after this one, I tried to get short again, mucked the trade. This one was a fractional win to that fractional loss. So 4 trades, I'm 0 for 4 on follow through, and the market really hasn't moved much from where it was to where it now is. But just keep following the rules, just keep firing short, and now it does collapse when it breaks below this Z3. Adding the second position, taking the RLXD exit, nice win. Tried the owl and mucked it. Tried the continuation, it worked. When it crossed the VWAP the second time, or this next with a higher low, second position. Third position when it took out the previous Z3 line, and scratch that one. So that's a nice win on that direction. Not because I picked it right, but because the market moved in that direction, and I thought just follow the rules. And then the Fed announced here that they were going to do something, and so it went up for a little bit, and then the afternoon trade happened. But just to show, hey, not particularly elegant or slick, but just make an R and staying with it. Everything's still in the red today. There was no tactical difference in any of the 4 seasons. The daily trade, in spite of the Fed saying that they are going to print as much money as it takes, it still had a fractional loss today. Like 2%. It's hard to say 2% loss is a fractional loss, but it certainly felt different when the Fed announced. So here's the 1 day, here's the 10-day range. We're at the bottom of that. At the bottom of the 30-day range, we're at a 45% or 43% sell-off. It was at 45% at one point. We're deep in the winter at minus 45 on MACD histogram. But we're going to see if the Fed can make a difference. We'll see. So the Z3 line is already off the chart. We got the trading range breakdown. Then this is that 50% sell-off from the swing high. 41.70. Yeah. On the upside, we have the 1-day high. Well, actually, the blue line is Monday's open. The 1-day high, the skin of the dragon, spine of the dragon, and then the upper skin of the dragon and Z-1 are both there at about 260. PSAR flips at 270. This is the 10-day high at 290. The Bollinger Band mean and the RL90 at 297. Fair value at 313. The hump of the RL7 270. And then the 30-day high and the hump of the dragon. So that's the marching upward, if you will. Why aren't my other charts showing? Oh, here we go. Okay, sorry. Okay, some other series. So Boeing, I started getting interested in this after the Fed announced, although there was probably a hybrid frog in here somewhere. In this area, there's probably a hybrid frog. But I was playing the index, excuse me. Then the Fed announced whatever it takes, so I played here's a low, a higher low. I played the next pocket, so that's like a Z3 pinch breakout, and trying to front run the RL VWAP, and that coincides with a summer. And then it came back, and I just wanted to get paid on the long side of Boeing. How many times can you say that in the past, 3 months? I didn't get the continuation. Then there was a great big pinch and much more news, and so I got this Z3 breakout. I was too slow to get a second position, and I was afraid to add, and then I gave back a big gulp of that, and then it was just going too fast, and I didn't want to get stuck with a bad fill. But I'm happy to have gotten paid on that one. This one was the Treasuries was starting off with a hybrid frog entry. So there's the swing low, the belly of the 10, and the VWAP, and then it moves up from $1.70 to 158, from 157 to 158.50. So that's about a 1% manageable risk box, and then below the RL10. So just buy it at 158.50. Held. I thought hard about adding a second one here, but I was working a couple other positions, and I don't really trade the Treasuries that much. But then by this time it was a money management. I had to get back in with a second position, and then played the orderly Z3 pinch and the breakdown. Came all the way back to the VWAP. This is almost like this is a Z3 pinch, and then a breakdown to the VWAP. Held support. I bought the second leg up, the second RLXD, and then this spiked down from here, came through the dragon and through the VWAP, and so I got panicked out of it, meaning I didn't know what was going on. I wanted a money management stop, and then it was just too much, too many other things going on. But I got paid in Treasuries. This was a hybrid frog in Mexico. So this is my usual 20-cent adverse move, and it crossed the RL90. So I'm short. And the next breakdown I look at this like a collapsing dragon. So the second one down, and the RLXD exit, and a PSAR flip in the usual way. Tried to get short on the collapsing dragon, mucked the RLXD, tried the owl long, mucked that trade for a fractional loss too. Bought the next emerging dragon breakout of the hump of the 10. Bought the crossing of the VWAP. Took the next, what looked like was coming down to touch the PSAR, and it looked to me like I wanted to get something out of the second position, and that was enough. Then the Fed pump was happening, and I was playing the Treasuries and UDOW instead of some of the peripheral, the second tier. This one was Chevron. It's been like the worst of the energy sector. So this was a hybrid frog on about a 60-cent manageable risk box. That's about 1% from the VWAP. So sold off short. Energy was selling off too. So, and this was a little bit worse. So second position, just because it was like two execution R in hand, covered with the RLXD. Then I noticed it and energy were just traveling sideways. There was a triple bottom low, a higher low. So I bought the continuation pocket and mucked it, and then didn't have anything left in my emotional tank to play that one. My daughter sent me this one. We got a new puppy, ugly as heck, but he's laughing at all my jokes, so So in the chat room, this is from Eric. So I just want to let you study this real quick. Fantastic job. This is part of the monthly check-in, and this is what the brown belt test looks like. Got to be able to do this. It's got to all make sense and have a good write-up. So I want you to just kind of scan that for about a minute and see what you see. And then I'm going to, this is the markup that I gave him. So if you're studying this at home, you can pause the tape here. Make your decisions on what kind of feedback would you give him. And then, okay, so restarting. So this is the sequence that I go in. So the first thing I look at is the histogram. No matter what the time frame is, I look at the histogram. And the first thing I look at is, were there any losses greater than 1R? Nope. That's good. Now, between 1R and positive 2R, does it have a appearance of normality and positive expectancy? Yep, it does. And number 3, does it have the possibility of fat right tails? Yes, it does. So all good on the histogram. I like this thing already. This is robust. Number 4, I look at the equity curve. That looks pleasing to the eye, and you could endure that going from 0 to 28R. Number 5, I'm looking at the trade sequence plot, and there's a nice mix of wins and losses, and this looks like a system that's working. The rolling average R, this is about where it stabilizes. He's got it set up so it's decaying because it's going out to 177, but this is as far out as he's going. So his current expectancy looks like it's around 1, and so it's probably going to stabilize at 0.9. So that's really good. Number 7, this was his rules. He's using 2 ATRs as an execution R. He's studying an AI-directed ETF model. He's reverse engineering it. It has bull funds and then a bear and a bond gold mix on the bear side. And he looks at picking the 4 to 10 top components equal weighted in the bull funds with a monthly rotation and a 10% stop. He has some comments down in here about that. You'll notice that it has 30 trades, 22 wins, 7 losses, so his win rate is 0.75, and the average win to average loss is 3 to 1. Now, how many times do you want to play that? All of them? All of them. 3 to 1 coin flip, and then 3 to 1 payoff. And then this is the orderly flow. And then, so then I'm going to go read his commentary. He's looking at reverse engineering an AI model which chooses funds in bull markets at the month end. He looks at the main components and keeps them until rebalancing or until he puts a 10% trailing stop, which will then scale the portfolio out in case of a bear market, while keeping the strongest ones in case of a market resumption. It's satisfying. However, the standard month-end bull-bear indicator is not working properly in pandemics and extreme fear conditions, which is what we've been talking about, reverse engineering Wiz. It gets you out too late and then too slow to enter when the bull market. So he's now working on a risk-Z MACD scale-in model and maybe some CAN-SLIM follow-through days, which often happen when there's an RLXD with large daily volume. So it's a work in progress. He did not buy the bear funds for March because he's using some discretion. So very sensible approach, and you can see from the tone that he's approaching this scientifically and with his own responsibility. So very well done. Very pleased to see that. I'm honored by this. So in the chat room, this is his report. He's been working on this for 9 months. Because of reasons, which the pandemic started to show its face late in January, we had some discussions, and so he decided to add a 10% trailing stop because that satisfied him. Now, he's a little frustrated that he's not able to get more out of this market on the way down. I accept that. But I really want you to listen to this next paragraph. However, the money I didn't lose on my pension funds by being alert and discretionary, he was following a line of thought to get out of those positions that he probably would not have believed in if he hadn't been following our teachings. And that makes him humble because he changed his mind on the basis of evidence and took responsibility. And so he sold 50% of his pensions in February 3rd, 50% on February 10th in absolute safety. And then he went to cash in the AI portfolio February 21st to February 28th. And he went to cash in a savings account for his son's education on February 24th. I just am so grateful to have the opportunity to teach, honest to goodness. And I'm teaching my son to invest and trade along with me. We're paying it forward to the next generation. We feel that we're looking into an opportunity of a decade on the long side, regardless of the specific strategy used. I feel exactly the same way. I feel thankful that none of the above decisions were difficult, almost natural. I don't know if you know how powerful, I know you know how powerful that is. At the peak of fear of the last 100 years, these decisions taken in opposition to the herd in a logical, measured manner feel almost natural and easy. So I am just so humbly grateful for the opportunity to teach. +1 to you, Eric, and all of the Euros that are working together in the campfire coaching room to get this done. I'm just so proud of you guys. And I'm in humble awe of the work that you're doing together, getting it done. Just so pleased. No matter what else happens, that happened. So good on you. Speed run.